Hello, everybody. This is John Muntz with Dealer's Edge. I want to welcome you to this management topic update detailing our auto industry outlook and what's ahead for dealerships in 2025. With us today is our good friend Alan Haig with Haig Partners. Alan and his team are dedicated to facilitating dealership buy-sell transactions. In 2024, Haig Partners advised on 25 dealership transactions involving a total of 58 dealerships across the United States. These transactions ranged from high-value single-point dealerships to multi-point groups, including one platform valued at over $1 billion. Alan is our go-to guy for big-picture information as well as details on merger and acquisition strategies. We encourage you to ask questions throughout the presentation using the chat feature on the right. Also, we will be conducting 2 polls during the presentation. They're multiple choice. They will pop up on the right-hand side of the screen, and we encourage you to participate in those polls. I think that's it for the housekeeping. So without further delay, Alan, it's great to have you here as always, and the stage is yours.
All right. Thank you, John, and thank you to everybody who's tuned in here today. This presentation is similar to one I made at NADA at this Auto Team America conference that we helped to organize, and there are a lot of folks that have logged on today, and I'm wondering if some of you didn't have a chance to make it to NADA. So if that's the case, we missed you, but we're happy we could speak with you today. You'll see there's a QR code here on this presentation. You're free to download this or go to the website and get our reports where a lot of this data is contained and updated on a quarterly basis. But we do have some fresh information for you from some of the public companies that have filed so far about PVRs, et cetera. We're going to start with macroeconomic view, then get into some automotive data, then get into some franchise specifics, have a couple polls, and then a couple recommendations at the end. And I think John mentioned we do encourage questions along the way. I don't think anybody wants to listen to me monologue for an hour. So if you have any information that you'd like to discuss, I'll do my best to answer it. So with that, we're going to get going here. Talking from the macroeconomic perspective, our economy is in very good shape. I think you could say the envy of the world right now. You can see here, this is a gross domestic product. It's been very healthy here for the last going on 2 years. And hopefully the Q1 data for 25 is going to be equally positive, but growing at 2+% every quarter. A couple of the key macroeconomic indicators that folks follow are unemployment. It's low and steady at around 4%. Inflation, you can see that is the red line. It has been a challenge for the Fed to get inflation under control. They're not yet done. It's running at about 3%. You can see it's kind of ticked up here in the last couple months, unfortunately. And that's something which has been weighing on sales, consumer confidence, et cetera. Certainly was a big driver between the results of the election, and we have some mixed messages about what inflation could be going forward. Inflation is a big factor in our industry, as folks know, because it drives a couple things. The purchase price of the vehicles we sell goes up, and the challenge of consumers to afford it goes down in terms of we have to increase the interest rates. So this is showing the interest rates, the Fed funds rates that are set by the Federal Reserve. You can see we peaked for about a year straight in the low 5s compared to basically 0 interest rates for about 2 years. We were expecting more declines in the interest rates by now. I think there are only 2 more factored in. And again, that's partly because of concerns about tariffs and oil prices and other shocks going on around the world. The higher rates impact affordability. And when we talk to our friends that own dealerships, what just about everybody says is, well, I could sell more cars if I had the right model mix, but also customers are having a hard time affording vehicles today. I think the average purchase price per vehicles from the new side has gone up. Well, here we have it here. Before the pandemic, it was about $37,000 per new vehicle. Now it's up to $45,000. So that's, $8,000 change, 25% increase over just a few years. that's driving difficulty for consumers. Even though their wages have gone up, they haven't gone up as fast as inflation as vehicles have. So the number of weeks of income that our consumers need to generate in order to buy a vehicle has gone up. And we're still about a month more worth of income in order to buy a new vehicle compared to where we were before the pandemic. So that's something hopefully we'll get back to normal levels here later on in 2025. So SAR, that's the seasonally adjusted annual rate for new vehicle sales. You can see really in the years before the pandemic hit, we were running in the low 17s. It absolutely plummeted in the first few months of the pandemic down to around 8 million SAR. And we've been sort of recovering ever since. Last year, we were running about 15.5 million units per month was the rate. And you can see we were seeing at the end of last year a nice upward trend. We had kind of 4 months in a row of increasing sales. And I initially thought, well, this is perhaps higher consumer confidence. Maybe due to the election results, people were feeling more confident about the economy. But then when we started speaking with some of the larger retailers and economists, they believe that some of this increase in sales at the end of last year was really due to concern that some dealers had that the credits for EVs would disappear or the price of vehicles would go up due to tariffs. So people went out and they bought cars maybe before they were really ready to. And so that caused that lift. And then subsequently we saw a decline in January of this year down to 15.6, which is kind of where we were all of last year. So I don't know if this is just a temporary blip and we'll get back towards climbing up towards the 15.5 or $16.5 million number that I think, or unit number that we were hoping for in 2025. The big news in our industry since the pandemic hit has been the spike in gross profits on new vehicles. And prior to the pandemic, the average public company was generating about $1,900 in gross profit per new vehicle retailed. And we quote the public data because we know it's correct. We know it's pure. A lot of the data that comes from private sources, dealers account for their income in different places, other income or PACs, etc. But we know this is pure. It's the best way to really see what's happened to profits over the years. Those gross profits per vehicle more than tripled at the height of the pandemic. We were getting almost $6,000 per new vehicle retailed. Some of that was over MSRP, as many of you know. And then as supply increased, as the challenges of affording these vehicles increased, as the amount of savings consumers had decreased, pricing pressure set in. And you can see in 2024, we ended with about $3,400 in gross profit on new vehicles retail. That's just the front end. There's no F&I in here. So we were coming down quite a lot from the peak, but still almost double the amount of gross profit per vehicle retailed from before the pandemic. So still in very good shape. So one question we really had, in the second half of last year is, where are we going to land with these gross profits per vehicle? Are we going to go all the way back to where we were in 2019 or even just on an inflation adjusted basis? And of course, that number drives a significant amount of the bottom line pre-tax profit for dealers. So we show here these 4 bar charts on the right. What's encouraging to me about this is on a quarterly basis, the amount of gross profit per vehicle retailed. And you can see it's kind of leveled off. We ended the fourth quarter with about $3,300 in gross profit per new vehicle retailed. That's down, from almost $6,000, but it's still, gosh, what's that? $1,400 more per unit than we were in 2019. So we're going to ask some questions of you later about your opinions of profits, but this leveling off to us is very encouraging. It may provide a bit of a floor to dealership profits and then dealership values. And of course, there's great variation in this number based upon franchise. If you're Porsche, you're probably 3 or 4 times this number. If you're Nissan, you might be 1/3 of this number. Used gross profits, we're all the way back to where we were before the pandemic hit and worse, which kind of shocks me. Again, as we think about it, as we talk to our clients and our friends in auto retail, that dip in production of new vehicles is now resulting in a dip of supply of used vehicles. And because of the affordability crisis, a lot of customers want to buy used vehicles. So for dealers to satisfy them, they have to go out and aggressively compete to buy used vehicles. And so the spread that they're getting between the wholesale value and reconditioning costs and what a customer is willing to pay has shrunk to just $1,500 per unit. So we've really lost all of the gain that we had from the pandemic and more than that, especially when you consider, given the inflation in used car values as well, the percentage gross profit on a used vehicle is a good bit lower today than it was before the pandemic. So that's a little bit discouraging.
Excuse me, Alan?
Yes, sir.
Got a couple questions here. I'd like to hit them before we get too far along. One here from Patrick. Some Wall Street analysts are predicting 18 million SAAR by 2028. Do you believe that's possible?
I would say yes. If you think about the number of new units that weren't produced during 2020, 21, 22, 23, 24, compared to what was being produced in the past, there's a significant amount of, you could say, pent-up demand. 8 million units, 10 million units are missing from our units in operation across all brands all across the country. So I think it is possible that we could get back to that. It's going to require overtime from the factories. You know, many of the factories have taken out production capacity, such as Nissan, for instance, right now. But I believe if the interest rates drop to the point where monthly payments are affordable, remember that week's worth of income to buy a vehicle, if we can get back to where we were, I think it was 34 weeks of income, so 37 weeks of income. If we can get the consumer confidence back, if tariffs don't hurt us, there are a number of key ifs, but we absolutely need to get back to producing more and buying and selling more than the 17 million units we were averaging before the pandemic hit to account for that pent-up demand of vehicles. I saw some data, I guess a month or two ago, about the average age per vehicle that's out on the roads, and it's higher than it's ever been. I think it's around 13 years. And so if you think about what people are buying vehicles today, a lot of people are buying because of the new technology that's in the vehicles. All the screens, all the driving aids, the styling, the different drivetrains that are out there. I think there are plenty of customers that are riding around in vehicles that were built, you know, like I said, 13, 15 years ago, that are ready to trade in and move into a new vehicle if it were more affordable to them. And we still have a shortage of many key units like Toyota, Honda. They've not been able to increase their production as much as their customers would like. So we are going to get back to higher than 15, 16 million units SAAR, hopefully in the next 12 months.
Great. Thank you very much. We also have a question here from Ann on, I think, gross profit. Are you seeing those new gross profit numbers in California where we have a heavier lift on EVs?
So this is national data, and there are certain brands in certain regions where the gross profits are lower. You know, California is a more complicated story because you also have a lot of luxury vehicles sold in California. So the profits per unit on those are much higher than in other areas of the country where luxury sales are lower. But if you look at dealers' profits in California and compare them to the Southeast or Texas, they are lower on the front end gross profit. And some of that is because of the EVs. Now the situation's improving. You know, we would point to Mercedes as an example where Mercedes' initial EV strategy was very damaging to dealers because the vehicles weren't sitting. They had to advertise them. They had to floor plan them. They had to discount them. The gross profit on EVs was way lower than on a comparable ICE vehicle. And it was also a disaster for the factory. They had to significantly incentivize those vehicles to get them off the lot. So California and perhaps some other CARB space, but particularly California, has suffered from, I'll call it temporarily and artificially suppressed front-end gross profits because of the EVs. We're going to talk later about one of the risks that we have going forward, and a lot of it is what's going to happen with the CARB states and the current targets for EVs sold in those states. It's pretty daunting and probably almost impossible And if they're not changed, it's going to be very damaging to our industry. But the short answer is EVs have suppressed gross profits per unit significantly in California. I don't have exact number, but it's a real thing. So hopefully we're easing past that now, as Mercedes has changed its strategy, as BMW has proven the correct strategy is anything and above, hybrid, plug-in hybrid, gas, EV, whatever the customer wants, they're going to provide. That's what I think everybody's realizing is the smart thing, rather than try to force everybody into a full EV.
Okay, thank you very much. And then we got one more, and then we have to move on. This one is kind of out of left field. Are floor plan notes payable considered working capital in the industry?
Well, so the new vehicle inventory and the debt associated with that, the floor plan debt, I think in the industry, you just kind of, those two wash out. If you're looking at buying a business, you don't really look at the value of the new vehicle inventory. You don't really look at the debt on the new vehicle inventory. They just wash out. So that's not really considered an asset. It's not really considered a liability. It's just a zero. So in terms of your working capital, which my definition is current assets minus current liabilities, you have the assets from the vehicles, you have the debt for the vehicles, it's a zero. So it has no impact on working capital by my brain. And I think if you look at a dealer statement, that's probably what it shows as well.
Okay, thank you very much. And that's it for the questions for now.
Okay, so we talked about new units, we talked about used units. F&I, now this is an interesting story. F&I is a highly profitable department for the publicly traded dealer groups. I would say they're leaders in the industry in terms of the amount of F&I per vehicle they've generated. You can see from this chart, it was growing quite nicely, $200, $300 per year. And then when the pandemic hit, it really sort of leveled off. And there were a few reasons for that. One was people had a lot of savings and they saw the price of a new car. They took out a smaller loan, or they declined some of the products that were offered so that they keep their monthly payment in line with what they're comfortable with. So as the price per vehicle went up, you'd think this F&I number would go up because you have more to finance and more to insure, but it didn't. It leveled off. And I think to us, that's a function of the consumer saying, I can't afford more, so I got to put on more of a down payment or less products so that I can just kind of make myself comfortable with the purchase I'm doing here. So in all 2024, first three quarters, you'll see it was, going down a little bit, which concerned us. In the fourth quarter, we saw another lift to $2,500 a unit, which on this chart, that's the highest we've ever seen. So we may see consumers coming back and saying, okay, the interest rates have dipped a little bit. I'm comfortable taking out a bigger loan, and maybe I want to buy some more product, et cetera. So we're seeing an increase again, and we hope this department will continue its growth because we may have some continued decline on new vehicle gross profit. So I'm hopeful these will cancel each other out.
Alan, we have one quick question on F&I. Is F&I measured before or after chargebacks and cancellations?
This is pretty much the net number as treated by the public companies. I think they're showing the net number.
Okay.
Now, the public companies don't have reinsurance companies typically. So for many private dealers, they have the F&I income on a per vehicle unit they can track at their dealerships. It's probably going to be lower than this, but many of them also have a reinsurance company where they're making a significant amount of profit that's off the income statement of the dealership. So just so you're comparing your numbers to the public's not feeling too bad about yourselves, you're getting reinsurance income, they are not. Okay, fixed ops, a huge driver of profits for us over the years. I know a couple of years ago, we were all tearing our hair out and saying, where are we going to find these technicians? How are we going to supply these vehicles with the labor they need to repair them? And what we saw, the answer was just basically a spike in labor rates. And we have some clients in Florida and other parts of the country that are over $300 an hour now for the labor rates. And the customers are paying it because they need to get their vehicles serviced. So in the last quarter, Year to date, I should say, for 2024, we're running at about 4% growth on fixed ops, and that's off a nice increase over the last 3 years. So if we can have this low to mid single digit growth and fixed operations income, again, that's a really nice floor in our profitability per dealership and can help offset any declines in front end gross or increase in expenses. So we roll it all together, new, used, F&I, parts and service, and the bottom line after expenses are the numbers we're looking at here. Prior to COVID, the average dealership owned by a publicly traded company was making about $2 million a year. It more than tripled to over $6 million at the peak of the pandemic, and it's now drifted down. If we look at, we just have the profitability from the data, or profitability data from the public companies through the third quarter of last year, and it was averaging $4.1 million per store. So a little sad, it's down by a third from what it was at the peak, but pretty happy we're still twice the level where we were before the pandemic started. So 4 million per location today in profit, 2 million prior to the pandemic. That is double, and that's more than the rate of inflation. But that's history. People put that money in the bank, they bought stock with it, they put out dividends, they bought dealerships with it. You know, what we all care about now is what's the future. And you can see here, what are we looking at for the future of the business? I'd kind of like to, I think our poll is next. Is that right, John?
Yeah,
I'd like to get your opinion.
There we go.
You know, what do people on this poll or on this webinar think is going to happen with dealership profits in 2025? Are we looking at higher than 24, about the same as 24, or lower than 2024? So please, I'm going to be quiet and allow you to think and vote here.
Okay, folks, you should see the poll up on the right-hand side of your screen there. I know I see it, but I don't see any. Oh, there we go.
Do you click on the? How do you vote, John?
I believe you just click on the one you want to vote for.
So you put your cursor on the higher than, same than, or lower than on the right side, or?
Yes, we do have a few votes came through. We're at 14% said higher, 43% said same, and 42% said lower.
Okay, that's interesting. We did a poll about about 3 months ago, and the results were almost flipped, where the higher than 24 was about 46% and the lower was about 16%. So maybe we're feeling more pessimistic today. I don't know. But this is, you know, if I go back to this slide and I say, what's our downside? How low could our profits go this year? And if you say to yourself, okay, let's take new vehicle profits all the way back to where they were in 2019. So we're going right back to, we've had no gain. Used gross profits per vehicle, the same. But we keep the F&I gross profits per vehicle because we're not going to have a loss in the price per unit. So the amount that people are going to insure and finance is going to be the same in 2025 as it was in 2024. So F&I profits stay the same, and then fixed operations stays the same. So if you take two departments back to pre-COVID and keep two departments where they are today, the downside scenario is about $3 million per rooftop. So about 25% less than today, but about 50% higher than before. So to us, that's the downside case on profits in 2025. The upside in terms of profits may be where we are now, that we just go sideways on 4 million. The folks on this webinar, looks like they're thinking it's going to go down, who knows how much, but perhaps by another 10, 20%, which I could see that happening. Okay, so now we're going to get into some more franchise-related information. We tracked the changes in new vehicle sales by franchise from before the pandemic to today. What's the cumulative impact to dealers today in their new vehicle departments from COVID, from new models, from loss of models, et cetera? And that's what you see here. This is showing Mazda, for instance. They're on all the way on the left, which is the good guy list. showing that the average Mazda store sold 294 units more in 2024 than they sold in 2019. On the naughty list, if you will, are Stellantis dealerships that sold 356 fewer new units in 2024 than what they sold in 2019. And you can see everyone else in between. You know, Nissan's another company that's suffered a lot of loss of market share. They're down 330 units. And there's some other brands in here too that you might be a little surprised by. So for instance, look at Toyota. It's down 77 units. So it lost share during the pandemic. And we heard kind of over and over again from Toyota dealers that they just have had a hard time getting the products that they needed. Lexus, for some reason, didn't. Lexus sales are up almost 200 units per location. So this often is a driver of profits per location. So you could use this as a rough gauge of what's happened in the profits per dealership location by franchise over the last 5 years. Certainly, we saw a massive lift in dealership value at Kia stores and Mazda stores and Hyundai stores, for instance. This is the percentage change. So for Mazda, their sales of new vehicles per franchise went up by 60% from 2019 to 2024. That's just a terrific outcome. Lincoln did great. Kia and Hyundai, probably the other big gainers of market share. And those two brands not only took a lot of share, but the customers they're serving, the vehicles that they're selling, have gone significantly up market. You know, the Telluride, the Palisade really brought in a different kind of customer for those franchises. And I think it's also benefited their fixed ops, not just because there are more units in operation, but the customers they're bringing in are spending a little bit more money on maintaining those vehicles than they did in the past, or than the previous customers had. And then sadly, again, on the right-hand side, you'll see that Stellantis dealers lost 40% of their sales during that time. And when we talk to our friends with Stellantis dealers and really listen to the factory themselves, there were a couple of key drivers of that loss. The biggest one is Stellantis was increasing its prices per vehicle at the wholesale level, so to the dealers, more than any other OEM. And that was some data that I think the Dealer Advisory Board tracked and provided to Stellantis. So they were raising their prices faster than the customers could follow them. And a lot of the customers that had a Jeep Wrangler or a Jeep Cherokee just said, we're not going to follow you. I can't buy another vehicle. I can't replace the one I have now at the new price. They also cut some key models, like I think it's the Cherokee, not the Grand Cherokee, but I think it's the Cherokee. There was something like 13% of their sales in 2019. They cut that vehicle and they didn't replace it with anything with comparable volume. Now, I think that they're on the mend and they realize the error of their ways. And I expect next year that sales for Stellantis will be higher than they were in 24. Okay, let's get into the M&A portion. And again, I'm happy to take questions along the way. The number of new vehicle dealerships bought and sold over the years has fluctuated significantly. Prior to the pandemic, we were selling around 300, 350 stores. We saw a trade per year. It more than doubled in 2021. That was kind of the peak of the activity that we saw when we saw over 700 dealerships trade hands. The red portion of this bar reflects the acquisitions, the number of rooftops by the publicly traded companies. And you can see that, again, prior to the pandemic, the public companies were buying 20 or 30 stores a year. What we don't have on here are the divestitures, but they were often selling 10 or 20 stores per year. So the public companies weren't really growing that much in terms of their dealership count. Consolidation was actually quite low before the pandemic hit. Since the pandemic hit, you can see the red bar has gone up quite a lot. And in 2021, the public companies bought over 200 stores. Lithia was a lot of that, Groupon was a lot of that, et cetera. That also corresponded with a huge spike in dealership values, which we'll show shortly. And I think that some of the publicly traded retailers began to think, well, maybe I shouldn't be buying dealerships right now when they're at the peak value. Maybe I can use my cash flow to buy back stock or provide dividends to my shareholders or do something else that can improve the long-term value of my share price as opposed to buying stores. So we saw public company interest sort of decline and go kind of flat. Now, they were replaced by private dealers who in the last couple of years have been buying, more than 90% of the stores that are being acquired out there. If you're a private dealer, you've got 2 stores or 10 stores, you're making record profits. Many people had already paid off their mortgages. Some of them had paid down their floor plans. They bought their aircraft if they wanted one. They bought their boat if they wanted one. They were really having fun as dealers. They didn't have a stock they could go out and buy like AutoNation or Group 1. The way for them to reinvest in their company was really to buy another dealership. So if the right dealership came up in the right market at the right price, they were buying it. So the public companies have been the ones, or the private dealer groups are the ones that have been consolidating the fastest over the last 3 years. Now, many of you read earlier this week the announcement that Asbury was buying the Herb Chambers Group in Boston. So on the right side of that page, 2025 estimate, what we have in there is we know at least 33 rooftops are being acquired by the publicly traded companies because they're going to close on that, I believe, this quarter. We're estimating, we're kind of grossing up, if you will, the amount of deals that will happen on the private side, just kind of level where we were in 24. But I think there's a good chance now that the dealership values have dropped a little bit. And there are a lot of stores for sale in the market now. Some of the stores that are for sale in the market now were acquired in the past 3 or 4 years as a part of larger acquisitions. And some of the consolidators are like, well, I've got a couple of Nissan stores that I bought with this group and I'm not able to make them work, so I'm going to sell them. Or I bought this group and it came with this outlying asset, so I'm going to sell that outlying asset. So I think we're going to continue to see a lot of M&A in 2025, and we're already off to a fast start with the publics.
We have a quick question on that. To your knowledge, with the acquisition of Herb Chambers and the framework agreements, will they need to sell any stores?
It's common in a large acquisition that the buyer would elect to sell some franchises. I don't think that Asbury has other dealerships up in that market, so it won't be because they are duplicating or overlapping with their existing mix. But many of the OEMs, such as Toyota or Honda, will say you have a limit on the number of our dealerships you can own. So it is possible, and I think Asbury should speak for themselves what their plans are. But I would say almost after every large acquisition, there will be a handful of stores that are sold for various reasons. They're too small, they're in the wrong place, there's a framework issue, etc. So it's probably likely there'll be some asset sales, would be my guess.
Okay, thank you.
Okay, this chart shows the amount of dollars spent by the publicly traded companies over the years. Again, that peak that I mentioned in 2021, they spent about $9 billion on U.S. acquisitions. And so if we look at what could happen this year, they've already spent $1.3 billion on Mr. Chambers dealerships. Our hunch is that other companies, publicly traded companies, are going to be doing acquisitions as well. So we believe we could go back to like a $4.5 billion number between what they're going to buy in the U.S. and what they're going to buy abroad. The public companies have done very well. Their stock prices are high. It's hard, perhaps, for them to argue their stock is undervalued. Maybe the way for them to grow their share price again is by growing through acquisitions again. Okay, so we talked about some macroeconomic issues. We talked about gross profits per unit. We talked about how that drove profitability per store. We talked about the number of rooftops being bought and sold. We're going to get into dealership values now. This data comes from our third quarter Haig report, and it tracks the estimated blue sky multiple by brand on a nationwide basis. So a Porsche store sells on average nationwide, we have it trading at 9 to 10 times pre-tax income, adjusted pre-tax income, plus assets, and plus the real estate. Some markets are going to bring higher prices. So for instance, you see Toyota on there that has 7 to 8. The last really 2 Toyota stores that I know of in Florida were at 10 times. So it can vary significantly by geography. California is bringing a little bit of a discount right now. There are worries about CARB issues. There are worries about taxes. And thankfully, there is some positive momentum in California with governments realizing that they need to focus on their taxpayers as well as other people that are in that state. And so I know that the city of San Francisco is really focusing on cleaning up the streets and making them safer for people and for businesses to return. I expect Southern California is in the same mindset, and I think many cities are realizing that we've got to make this a pleasant place to live and work so our citizens don't leave us and move to different states. We increased the range in the last quarter of just one franchise. That's Mazda. We took it up about a half a turn, and we decreased a couple there too. You'll see Audi and Subaru. We took each of those down about a quarter or a half turn. Audi, just because the product is a little bit stale, and we've heard complaints from Audi dealers that their profits were resulting, they were showing that. Audi's part of the Volkswagen group, and they've been focused a lot on EVs, and the EVs that came to market just didn't do great. Now, the good news is there's a new Q5 coming. That's a core product for Audi, so we hope that that's going to result in a nice rebound in sales. Subaru, it's a little bit of a powertrain issue, is what we're being told, in that they just don't have hybrids. They kind of are behind some of their competitors, particularly Toyota, and also the Korean brands that have hybrids and more electric vehicles. And Subaru is a brand that does well in a lot of the CARB states where the EV sales have been the highest. So they just haven't had the right product to really match up well with a Toyota or a Honda or a Tesla, and they've suffered a bit as a result. So on the far right side of the page, you'll see Infiniti. We're not seeing that trade as a multiple of earnings because I think most Infiniti stores are losing money, so there are no multiples to apply a multiple to. It's really kind of flag value, and we've seen some Infiniti stores, it's zero blue sky, just please buy my real estate at appraised value. In other cases where the market is better and the volume is there, and perhaps there are some earnings as well, we're seeing as much as $2 million for an Infiniti store on average. That's the range that we would see. Haven't really seen much change in the desirability of some of the core brands like Ford and General Motors. Buick dealers are getting paid $3 to $4 million to give up their franchises. That's quite a lot, and I think it reflects, hopefully some conviction on the part of General Motors that they care about dealer profits, and that they want to have fewer dealers. The Buick dealers that will remain will be able to sell a lot more Buicks. So we like to see them supporting the profitability of their franchises by directly shutting some down because they're just too many.
A couple questions before we get to this next slide.
Okay.
Was the 1.34 billion amount real estate and franchise, or just franchise?
It was real estate and franchise.
Okay. And here's one from Chris. If I'm interpreting this correctly, is this graph saying the average pre-tax income for Lincoln, for example, is 500,000? Which I'm not sure.
No. This graph, if you're talking about the blue sky multiple page, what this is showing is that if you are a dealership buyer, we believe, let's look at Lincoln for instance, we believe the average dealership buyer would pay 3x to 4x adjusted pre-tax profits, annual profits, to buy Lincoln franchise. These are not dollars. These are multiples of pre-tax profits.
Okay. And we have one other question here. Are you seeing challenges related to floor plan financing with underperforming stores and struggling brands?
We are hearing that certain banks are curtailing lending, floor plan in particular, for some of the brands that have aging inventory. And that's not uncommon. That's something that banks always do. If they see, hey, you have this vehicle in your lot for a year or longer, you're going to have to pay down some of the flooring. that has happened with some of the Stellantis brands and some of the Nissan brands, and really the other ones that have really high day supply. Now, thankfully, Nissan, I think, has shut down some production, so that day supply is declining. Stellantis is reducing production and increasing incentives, so that those day supply is reducing. So we're hoping that that period where the banks are curtailing flooring lines is going to go away from us. We're making some inquiries to some of the lenders about how do they feel about financing Nissan acquisitions today. How do you feel about financing Stellantis acquisitions today? Are you going to do that? And so far, what we've heard is yes in most cases, but in some cases they're going to decline. You know, if it's a big blue sky number and a big money loser, some banks will say no thanks unless the buyer has a lot of additional assets that they could pledge or income that they could pledge. So when things get worse, banks get nervous. That happens in every kind of downturn and a recession. And you could view 2024 as a recession for Stellantis and Nissan dealers. It certainly was a big decline from where they were before.
Okay, thank you.
Speaking of which, I'm really curious to get people's opinions. We've got 3 brands on the board here: Toyota, Nissan, and Stellantis, and I really would love to get people's opinions for each of these brands. Is Toyota going to do better? This is profitability. Are they going to do better in 24, the same, or lower? And then after we get the results, we're going to go to Nissan, and after we get the results, we're going to go to Stellantis.
Okay, so Toyota is up now, folks. Please enter your responses. I think it just takes a second or two for them to register for me here. My vote would be higher. Okay, we have 48% says higher, 39% says same, and 12 says lower.
48 says higher, 12 says lower. So 4 times as many people think higher than lower. Okay. I don't see that on my screen. John, I don't know if other people are seeing it, so thank you for reading out those results.
Okay.
Can we go to Nissan now? So again,
Sure.
Nissan had a tough year last year. In 2025, do we think profits at Nissan stores will be higher, about the same, or worse?
Okay, so that's up. The early responses are saying 28% higher, 23% same, and 47% lower.
So people don't believe we've hit the bottom yet for Nissan. That's a little concerning. Okay, how about Stellantis?
1 second. All right, Stellantis is up now. I think Stellantis can only go up. Let's see. Please enter your responses. Why aren't these showing me? Oh, here we go. 56% said higher, 26 said same, and 17 said lower.
Okay, that is certainly some enthusiasm. That's about 3 times as many people said it's going to go up as go down. So that's encouraging. That matches a little bit what Daryl Kinningham said. We had him on I had him on the stage at this conference at NADA that we host every year. He's the CEO of Group One of the publicly traded auto retailers, and I asked him about their acquisition strategy, what brands they were looking at, and I asked, would you buy a Stellantis store? And he said yes, in the right market. And I asked if he would buy a Nissan store, and he said not yet. I think that's what he answered, or just simply no. So the group here reflects, I think, Mr. Kinningham's sentiments as well. Okay, so shaking all that out, this chart shows the profits per dealership over the last gosh, 8-10 years. And again, before the pandemic, so I mean, this is blue sky value, not dealership value or blue sky profits. This is taking how buyers have been valuing blue sky over the years, and that's a function of the multiple and the earnings at the dealerships. And prior to the pandemic, we were seeing often about $10 million in blue sky per store. That went up almost 2.5 times to 24 million in 2023, which is kind of the peak of the demand that we saw. So more than doubled. And since then, we've seen a decline, but it hasn't been massive. We're down about 12% off the peak, according to our data and the conversation we've been having through the third quarter of last year. We'll be updating that in the next couple weeks. You can turn back in and go to the website to get our year-end report. But I would guess that's probably going to be in the high teens, maybe still around 20 million, just because, as you may recall, the profits per dealership are still quite high, more than twice what they used to be. And there's still a lot of cash. Dealers have made a lot of money. They want a place to put it. They want more dealerships. So the blue sky values are remaining quite elevated from where they were before. And we share this data really for two reasons. One is if you're thinking about growing and you want to buy more stores and you're waiting for profits to go back to where they or values to go back to where they were, I don't think they're going to go back. If you're waiting for them to get cheap again, I just don't see that happening based upon the transaction values that we're able to get for our clients. And if you folks are interested in selling and you're concerned you missed the window of 21, 22, 23, it's still a good time to sell most franchises. Now, Nissan, maybe not. Maybe you want to hold for 6 months for a little bit more positive sentiment for Nissan. But we share this information with folks to give them an idea what they can expect if they want to go buy or sell. Dealership values are still about twice what they were before the pandemic. Now, how accurate are our estimates? We do a little report card on ourselves, and every year we go back and we look at, hey, the clients that we spoke to, we gave them an estimate of blue sky value before they went to market, usually before they hired us. And we try to under-promise and over-deliver. It's kind of our style, if you will. We want to make sure that our clients are not disappointed. And so in 2019, we went back and looked at the blue sky that our clients accepted and compared it to the estimate of value that we'd given to them before they hired us. And what we found was that our clients accepted offers that were 98% of the midpoint of the range that we had estimated. So we said, hey, you'll get $19 to $21 million for your business. They got 98% number, so right around 20 million in blue sky. 2020, we went back and looked at what our clients accepted as a percentage of what we'd estimated. It had dropped to 86%. But as you may recall, that was the first year of the pandemic. So the estimates that we gave folks who sold in 2020, some of those estimates were given before the pandemic happened. And there was a little bit of panic selling in the first half of 2020. That showed up in these numbers. But then the pandemic got really good for profits. And we were giving clients estimates of what they could get based on what we knew at the time. And what we didn't know at the time was that we would see continued increase in profits per store. And it really, as you may recall, tripled the profit per store. So our estimates were underestimating value because we didn't anticipate profits were going to triple during that 3-year period. So in 2023, our clients accepted 131% of the value that we had estimated for them before they hired us. That's obviously good news. It's way better to get more than what you were told or estimated than less. So all of our closings in the last couple of years have been very happy days for our clients. And now with 2024, COVID's a little behind us, profits are coming down, values are coming down. We just ran the math here recently. Our clients accepted blue sky values that were 108% of the estimate that we'd given to them. So we're not perfect on our valuation estimates. We do track it. We do talk a lot to buyers, et cetera. And so I think in general, our estimates are pretty accurate. What you have to really understand is what is a buyer willing to accept in terms of the adjustments to the pre-tax profits that show up on dealer statements. And that's where we have some proprietary knowledge. Okay, so that's all the history. What about going forward? What can we expect? What are the opportunities? What are the risks? I went back and I looked over time at all the risks that I could think of to this industry, and there are a lot. Look at all these words on the page. These are all reasons that people thought I shouldn't buy a dealership, or I don't want to invest in the dealership industry, or the future might be worse than the past. I mean, it's unbelievable how many things have hit auto retail, and we're still generating significant profits per rooftop. So we have to take every new risk with a grain of salt and remember all the previous risks that the entrepreneurs on this phone call were able to overcome by delivering the customer what they wanted. So this data looks back over, I don't even know what this is, 32 years. And it shows the average pre-tax margin for a franchise auto dealership. And despite recessions, despite financial crises, et cetera, the average dealership's making 2%, 3% net to sales. Now, this doesn't include the spike we had from COVID, because that is likely an anomaly. Despite all those risks, you can kind of expect to get 2 to 3% net to sales. So it's a remarkably consistent business model. If you look at the profitability for the OEMs, the parts suppliers, they're way more up and down. Remember, we had General Motors and Chrysler went bankrupt not too long ago. So auto retailers, they don't like to hear this term, but I refer to them as kind of the cockroaches of retail in general. They just are going to survive any kind of nuclear blast that the world can throw at them and keep going. Okay, so again, that's history. What about the future? Is it going to be worse in the future than it is today? So we looked through, to us, some of the changes that we're seeing and what impacts it could have on auto dealers. The top little bubble there is the CARB rules, and some of you may know if you live in a CARB state, they're quite onerous in terms of the requirements that factories have to sell a high percentage of their vehicles being electric, zero emissions. I think it's 35% of 2026 sales have to be 0% or zero emission vehicles. There's not really, other than Tesla, there's no manufacturer that can hit that. Speaking of Tesla, their sales have slowed. Perhaps everybody who wanted a Tesla has bought one, but Mr. Musk is working hard on a new product, which is his fully self-driving technology, and that would be in the form of an autonomous vehicle that wouldn't have a driver in it. So Uber would just be like the Waymos that you see in San Francisco or in Phoenix. And if you're a consumer, you can just sit in the back seat and watch a movie or take a nap, and your vehicle will take you to your destination. Tesla's really the only company that we know is going to have this in the near future. Waymo is still more of a test. But if Tesla develops this technology and it's approved on the roads, then we could see a lot of sales gained by Tesla and lost by other automakers. China is taking a lot of share in the markets it's allowed to compete in. Their electric vehicles and overall vehicles are much lower than vehicles produced in the United States or Korea or Japan or Europe. And they have become remarkably good in terms of the quality, the features, the benefits, et cetera. And then at the end there, you have tariffs. Let's get into each of these a little bit. President Trump, love him or hate him, is making a big impact every day. I mean, I wake up at about 3 in the morning and I check my phone to see what happened yesterday afternoon that I was unaware of, that I need to know about. And so on the CARB side, I mentioned before, it's really going to be extremely difficult for any factory and therefore any dealer to meet these requirements for zero emission vehicles sold in their states. So unless California blinks and the other states blink, we're going to have a massive loss of sales at franchise dealerships in these, I think it's 14 states, 18 states. And now, and probably a big jump in the states bordering the CARB states. The folks from Virginia are going to drive south to North Carolina to buy their vehicles. That good for North Carolina, terrible for the dealers in Virginia. So we're hoping that there's going to be some relaxation in these standards and something along a more gradual path will be enacted. Chinese brands, When the brands enter, they take share. You can see what's happened in Mexico. They've already got about 10%. In Europe, they have about 10%. We already have BYD manufacturing in the US. You may have read about this massive oversupply of apartment buildings in China. The government pivoted not too long ago to the automotive sector, and they've pumped, I don't even know, hundreds of billions into supporting Chinese manufacturers of all vehicles, including electric vehicles. And there's been so much money spent now that there's a massive overproduction, underutilization, et cetera. And the Chinese market can't absorb all these vehicles, so they want to export them to our shores. So that is going to be something that we'll see what happens. I know President Trump's already talking about a 25% tariff on these vehicles. That might not be enough, and we might see a significant lift in sales of Chinese made vehicles here in the United States. Would they open up their own dealer network? Hopefully. So maybe auto dealers would lose sales at their Hyundai or Kia sales, but they could pick it up at their BYD dealership. But there's no guarantee that they're going to provide these dealerships and the retail to the retailers. And then we have tariffs. We talked about this a little bit before. We have a big chunk of the U.S. vehicles are manufactured outside of the U.S., and there are lots of components that go into the vehicles that were made in the U.S. that were produced outside the U.S. So you have significant impact not only on preventing Chinese vehicles from coming in, but the vehicles that are sold here today could be going up in cost significantly, which further worsens the affordability crisis I talked about at the beginning. So now we're back to Tesla. Many of you have seen Elon Musk seems to have a seat at the Oval Office as well, and the White House and in Mar-a-Lago. He's playing a huge role in our economy right now. What is he going to be pushing for? What's he going to be saying in President Trump's ear? What impact will that have on our world? He doesn't really need EV subsidies because his already has a price advantage over Ford and General Motors, so he might want to eliminate these. But that unfortunately makes Ford and General Motor products that much less desirable to U.S. consumers. Is he going to try to say, let's keep the CARB regulations in place so he can sell a lot of Teslas in those states? Is he going to be saying, let's just, just require these autonomous vehicles to be allowed to be operated on our roads? What does that do to the millions of truck drivers and bus drivers and cab drivers and Uber drivers and Grubhub drivers? Do they all lose their jobs and all that value goes to Mr. Musk and his shareholders? And China, like these are all kind of, Mr. Musk has got a big investment in China. He's got one of his 4 big manufacturing plants there. He's going to want China to treat Tesla well. Is he going to advocate for lower tariffs on Chinese imports? Now, we've looked at all this risk that we had, all the risks that we have today. This is what the investment community is doing. They're buying. They're buying the stocks at Lithia, at Penske, at AutoNation, at Groupon, Asbury Sonic. Everybody's up over the last 2 years. We haven't seen any diminution in appetite for shareholders. No one believes that the end is imminent. Everybody is more or less bullish, and we've outperformed the S&P 500 the last few years. So this picture we took off, I think it's from one of his campaign stops. And if you ask us, how do we feel about the future? This is kind of what we're doing. Like it's not perfect, but it's looking pretty good. Whether you like this gentleman or didn't vote for him, this is the sentiment that we're hearing from dealers. They're excited about what they're seeing on their showroom floors. They're excited about some of the changes that could be coming. Nervous, but they're used to the risks as well. So, what are they doing with their excitement? Well, some of it is buying stores. And we expect there are going to be over 500 dealerships that are going to trade this year. So if you feel good, if you're feeling like that, and you like the business and you want to grow, you should be in the market because there are stores available for you to purchase. If you are feeling like this, whether because you're not sure about the outlook or you're just at the age when you want to do something else with your life, it's still a good time to exit because the dealership values are still quite high. with the exception of these two franchises, Nissan and Stellantis. We actually think if you're a first-time buyer, like you're an independent dealer that wants to become a new car dealer, or you have one store and you want to get a second store, but you have a budget, this is a chance to buy Nissan and Stellantis stores at a low. I really think, especially for the Stellantis stores, they're going to probably be as low in blue sky value now as they're going to be for quite some time. They're certainly a lot lower today than they were 2-3 years ago. It was only like 2 years ago, I guess it was, that we set a value for selling a Stellantis store for more blue sky than anyone ever paid for a Stellantis store. So I hope we can get back to that level. Nissan, there's still some concerns, at least by this crowd, that maybe we haven't hit the worst for Nissan, but it doesn't mean you shouldn't be out there looking at them and perhaps looking for an opportunity that fits you in terms of your geography and value. So those are all the prepared remarks I have. Again, you can download the presentation from this QR code. And I don't know if there are any other questions that I can help with at this time, John.
Yeah, we do have a few questions here. There's also a link to download the presentation in the chat. Here's a question from Rob, which I'm not quite sure about, but I'm just going to read it. Is pre-tax income after sustaining capital?
I'm not sure I understand the definition of that. If you're growing a dealership, you do have to increase the amount of working capital you leave in the store. So if I went from 50 million to 60 million in sales, I probably would need 20% more working capital. So even though it's considered a profit, I would have to leave some of it in the dealership to finance that higher level of sales. You do have to invest in furniture, fixtures, equipment at a dealership, whether it's computers or desks from time to time. So that doesn't really show up it shows up on the income statement in terms of higher depreciation expense. And then of course, there are some franchises, some facilities that need to be upgraded from time to time. So for instance, Honda has a new image program. So sometimes in a buy sell, the buyer is going to be obligated to invest several $1,000,000 to replace the front of the building rather than the beer can friendly blue wave. It's going to be more flat and glass. I don't know if that's what the question is referring to, but it is true that some of the profits you can't just directly put into the bank. You do have to reinvest in your dealership.
Okay, and he did follow up. He said the pre-tax income that is applied to the multiple, is that simply EBITDA?
So it is the pre-tax dealership of the income as it shows on the statement. You would add back any amortization of goodwill running through there. There's probably 15 other add backs that you would consider. One is the rent factor correct? Is it a market rent? Is the dealer taking out a salary on top of what the GM is taking? That would be an add back. Is there any jet fuel running through that statement? Are there yacht expense? Is there legal expense unrelated to the dealership? Are there family members in the dealership? Was there a one-time gain or loss of any other kind? Those are all adjustments that need to be made to get to an accurate reflection of cash flow at the dealership level. And that's something that we spend a lot of time on. We're trying to come up with the income that we can show to a buyer that is repeatable, sustainable, in addition to we're looking for the future and trying to project what the business will do after a buyer owns it.
Okay, here's a question from Scott. With blue sky and profits cooling, what impact have you seen or would you expect to see on the value of the underlying real estate?
So far, we've seen gradual increases in real estate during the pandemic time. Some of it is because there's been a significant increase in the cost to build a new facility. The cost of the materials, the cost of the labor has gone up a lot. And in my opinion, the appraisal firms that we use when we're hired to sell a business, our clients will go out and get appraisals on the properties that they're selling. I think they're often undervaluing a dealership because the replacement cost, if you were to go out and build that showroom and parts department, everything new today, is a lot higher than it used to be. So You could say property values during COVID, commercial property values, some of them declined because people were staying home. They weren't going out to eat at restaurants. They weren't going to the office. So commercial property as a whole probably suffered a little bit during COVID, but we have not seen that at the dealership level. And it's because these customized facilities are absolutely necessary in order for these businesses to operate. And the businesses have been generating record amounts of profits. So we didn't see dealership real estate values double or triple like we saw blue sky values. We saw kind of a steady increase, 2 to 5% per year, I would say, over the past 4 or 5 years. So no diminution. Even if profits decline a little bit, we still have this inflation that's built in. I don't see dealership values going down unless it's for a franchise that is performing or selling way fewer units than it used to. So for instance, if you have a Nissan store that used to sell 1,000 new and now you're selling 700 new, that facility is still sized for 1,000. And as a buyer, going to look at that and say, I have a hard time operating the store with such a big and expensive facility. I can't pay you, even if it appraises for that value, maybe I can't pay you the full appraised value because it's just too big. And so we may see some of that where a seller will say, okay, but I'm going to keep an acre or two in the back and use it for self-storage, for instance. I'll cut the price to you, but I'm going to keep a little bit for me.
Okay. And we have a good tack on to that question from Lonnie. When buying a store that is due for an image update, how would you calculate that into the blue sky value?
It's a little bit of where the sausage is made. It depends upon the franchise. So for instance, if you are going to buy a Honda store and it's an old design, it's the beer can that hasn't been redone, you're going to, as a buyer, you're going to go to Honda and say, hey, I want to buy this franchise. And they're going to say, okay, you got to expand or you got to renovate. But Honda has a program where they give dealers additional inventory who are providing renovations. So there's an ROI, there's a return on investment, a positive return on investment for a Honda building, for instance. So if I'm the seller, I'm like, okay, I get it. You need to pay $2 million to upgrade the facility, but how many cars is Honda going to give you, right? And maybe I'll just keep the store and do the renovation myself, get the extra cars, make the extra money, and then sell you the business. And then sometimes, but no, I'll do it. I'll just take the store now. So there may not be an argument on a Honda facility needs an upgrade. In the past, there were some brands like Mercedes, and this is years ago, where Mercedes had Autohouse Image 1, which had, for instance, blue painted poles out front. And then a new CEO came in and wanted Autohouse Image 2, which is got to paint the blue poles black. And the buyer had to do that. For the buyer, there's no lift on that. They weren't getting any more units. It didn't enhance the experience at all, the customer. It was just cash out of pocket. So sometimes we would see buyers say, well, I got to invest $2 million post-closing, so I'm either going to take it out of the real estate or I'm going to take it out of the blue sky or somewhere in between. And that's kind of where the sausage is made on a deal. You don't exactly know what impact you're suffering, but you know you're suffering something from an image upgrade that doesn't come with any benefit to the buyer in the form of extra inventory or extra margin. So for instance, on Genesis today, for Genesis dealers that have built standalone showroom, they're getting significantly more margin per vehicle than the dealers that still have it in their Hyundai showroom. So that's the positive ROI for Genesis dealers. Question is it enough? I think it's a few $1,000s per vehicle they're getting on top of what other people are getting. But the cost of a standalone Genesis store is $15 million, and the volume per location today is still quite low.
Okay, thank you. Here's a question on the EVs. I think this goes back to your slide with the CARB states. I thought PHEV, which I'm not exactly sure what that is. Maybe it's hybrid electric vehicles.
I think that's the plug-in hybrids.
Okay, plug-in hybrid vehicles do not count towards the 35%. I thought it has to be 35% zero emissions.
I believe there is a formula that CARB has worked out. And so, for instance, hybrid does count towards it, but it's only like 20% of the hybrid. The not plug-in, but just where it has a gas engine and a battery that go back and forth. I think 20% of those sales do count towards the 35%. It's possible the plug-in hybrids also have a less than 1-to-1 impact on that, hitting that 35%. I'm not an expert in that area, but I do know that it's such a tough target number bar for these factories. You know, we talked to a leading OEM, we're like, how are you going to handle CARB in California? And they kind of looked around the room, no one said anything, and the one guy piped us like, we're gonna have Toyota handle that for us. Meaning that like the whole industry is relying upon Toyota to be able to go and negotiate with California Air Resource Board to say, hey guys, you got to roll this back. It's not possible to hit this. And if you do require us to hit it, it's going to have calamitous impact on your local economy, because there are plenty of towns in California that have built auto roads because they capture a lot of the sales tax revenue from new vehicle sales in their towns. And if new vehicle sales plummet in those towns, there are going to be a lot of upset citizens, and it has political consequences. Hey, I can't buy an F-150 with a gas engine in it in California. I'm going to change my vote next time. I'm voting for someone else, or I'm going to leave. So I think that everybody's got to be really cautious here on the CARB things and come up with a common sense solution that works for consumers and the environment. You know, because I was in California last week, in Southern California, fires are all gone. But I've been going to California since I was, 22, 24 years old, Southern California. And the air really is cleaner. So there are benefits for what California's done over the years. And I'm guessing the health for Californians is better. So we're not anti reducing emissions at all. I think it makes the air better for all of us because the air moves. But it just has to be done in a practical, realistic way to improve air quality standards. You can't have these draconian, quick lifts, or it just can devastate an economy.
Right. Okay, thank you. This question goes back to a little Twitter exchange you had with Mr. Musk at one time. David asks, please comment on the potential risk of Musk convincing the administration to allow direct manufacturer sales to consumers.
So Mr. Musk is doing that today. He has exemptions. He's achieved exemptions in all 50 states, plus the District of Columbia, I believe. So he's not restricted in selling direct to consumers. He's built a lot of dealership locations and service locations. Maybe he would like to have some more, but what's slowing his sales now is really not franchise laws. It's really just the consumer demand, in my opinion, which is why I'm encouraging him to establish a franchise network, because I think we could help him with that slowdown. Other OEMs have been frustrated by direct-to-consumer sales restrictions that are been put in place by state franchise laws. I don't think that President Trump has the ability to go in at the state level and reverse those franchise laws that were established to protect small business owners from giant global companies doing things that were unfair to them. So I know right now that a number of large dealers in Florida are suing Scout for its attempts to sell direct to consumer. I spoke to one of those dealers, and the dealer said to me, they have Volkswagen. And they were saying, well, I never wanted to sue my manufacturer. That's not really what you do if you want to have a good partnership. But Scout is not my manufacturer. You know, so in their mind, they're not guilty at all at suing Scout, because Scout's, according to Volkswagen, like a different company. So they are not afraid to sue Scout directly. And my guess is that the dealers will prevail, and that Scout will have to be sold through Volkswagen, which is where it should go. And I think it'll do better being sold by dealers as opposed to direct consumers over a website somewhere.
Okay, thank you. We got 3 more questions, and then we could wrap it up. Here's one from Larry. What's your guess with a Nissan merger or tech partner?
Great question. You know, we were excited, and I think some people have been kind of looking around like who could Nissan merge with, because they had Renault was going to be their partner. Then there was this terrible falling out with Carlos Ghosn and the Renault shareholders. And so it didn't look like we were going to have a lot of sharing of technology or economies of scales between Renault and Nissan. And so Honda was the next obvious target. They're both Japanese companies. They're both relatively small automakers compared to Volkswagen or General Motors or Toyota, for instance. And so when we saw Nissan suffering, the odds of a merger, in our opinion, went up. And when there was an announcement, a formal announcement that Honda and Toyota were in talks to merge, I don't know if people noticed that, but Honda stock went down, Nissan stock went up because the Nissan show was like, okay, fine, like somebody could save us right now and help us get this turned around. And the Honda people are like, oh, we're doing great now. We don't need anybody else to help us. Then a couple weeks later, it was announced that they are stopping the merger talks, and Nissan walked away from the table, and Honda stock went up and Nissan stock went down. So to us, it feels like the best outcome is to get back with Honda. Subaru is already kind of aligned with Toyota, and Mazda is already kind of aligned with Toyota. So I don't see a merger between Nissan and those two companies being possible. Toyota won't do it. We think the Japanese government probably would support a Honda-Nissan merger. To us, that makes sense. You could have some economies of scale, just like Hyundai and Kia do. That's the best analog. Hyundai and Kia are two separate companies. They now have some shared ownership. Those products are kind of similar, but differentiated enough so that consumers can choose their flavor. That's what I would hope would happen with Nissan and Honda. Now, I know there's talk about Foxconn perhaps partnering with Nissan. To my knowledge, Foxconn assembles electronic products designed by others. Maybe they have some of their own as well, but I think they're the biggest assembler of iPhones. It's not clear to me, I mean, certainly they're experts in batteries, but batteries that are in my phone or in a small device, not powering a 4,000-pound vehicle. So it's not clear to me how Foxconn is going to add value to Nissan, and therefore a merger to me, I don't know how it benefits a dealer, and that's who we focus on the most, other than maybe it's a capital partner for them. We hope they come back to Honda. That's our prayer, that works out.
Okay. Question from Steve. Are you seeing any OEMs requiring stores to reduce their footprint size?
No. We got to say you have to, they've pushed them for years to build these big stores. We haven't seen anybody come in saying you have to shrink an existing store. We have heard that if you're building a new store, the facility guides for new stores are less onerous than they used to be. So for instance, you don't have to stock or you don't have to have as many parking spaces as you used to, because nobody wants to have 100-day supply out on the lot. You don't have to have giant showrooms, because in theory people are already shopping a little bit at home before they come in to buy from you. But manufacturers still want to have a good service experience. They want to have a lot of service stalls. To us, we go into some luxury brands. Like I was in a beautiful Porsche store last year, and they have this massive customer lounges that they think are going to be occupied by customers when they're waiting for their cars to get serviced. A total waste of space. Porsche customer is not going to come and sit and wait for their car to get an oil change or tires rotated or whatever service work is done. They want the dealer to come and fetch the car, do the repairs, and bring it back to them when it's done. So that's an example where I think hopefully Porsche will realize that that's a waste of the retailer's money and not require that going forward. But we're seeing some minor changes as people realize less inventory, less in-time showroom, and let's make it more efficient for the dealer to shrink their overhead. The less they're paying for rent, the less they're paying for insurance, the less they're paying for utilities. The more they can put into their training and advertising and overall customer experience.
Okay, thank you. And this will be the final question from Chris. Hold on, he amended it at the last second here, threw me off. If there is a second, okay. When a dealership has a leasing division, how do you treat the amortization of the leased vehicle fleet in the calculation of pre-tax income? Also, if it is not added back to arrive at the pre-tax income, how would you factor in the cash outflows related to acquiring the leased fleet? And then he said, he changed that to is if it is added back. I don't know if you can see that in the chat. It might help you decipher it.
It's very uncommon. We don't see dealerships have leasing companies on the dealership financials. I mean, if I look at a dealership statement, I don't know if I've ever seen a leasing division. I mean, I see new, used, F&I, parts, service, body. I don't think I've ever seen a leasing part of a dealership statement. So if it's a separate business, you know, a lot of buyers might not want to buy a leasing company because they don't have experience with it. I think to me, it's kind of a separate company where you're buying a vehicle from a dealership, leasing it to a customer. You got income, you got depreciation, you have other expenses. You're going to net out to some hopefully positive number. I would guess it's a low multiple on that bottom line number. And that's assuming that your business is flat, right? Because if you're ramping up, you might have more depreciation than you have income initially. I'm not sure if I have a really good answer to that. I don't see it very often at all. We sold a dealership group in Ohio about 4 years ago that had a leasing company, and it was treated as a separate entity. It was not on the books of the dealership. The family owned it, but it was kept separate. In fact, when we sold the dealerships, the leasing company stayed intact. One of the family members, it was the daughter/sister, kept that part of the business for herself. Continued to buy vehicles from the dealerships and lease them to her customers from before, but it wasn't part of our transaction.
Okay, and I think that's it for the questions. So I think we can wrap it up for today. I want to thank everybody in the audience. We had a large audience today and a lot of great questions, and we always appreciate that. So thank you, everyone, for joining us. And I especially want to thank Alan Haig for putting this presentation together and providing us with this great information. Thank you very much, as always, Alan.
Well, John, thanks for having me on, and I appreciate everybody joining in today. And please, I look forward to getting your comments. A lot of this information, opinions, etc., come from conversations we have with people working in auto retail and also the factories too. So my phone number or email address up there. If you agree or disagree and want to talk about something, please don't hesitate to reach out. I look forward to it.
Okay, thank you very much. And with that, this is going to be John Muntz with Dealers Edge signing off for today.